Hello traders, welcome back to Nova channel and let's continue another topic today. In today's video, I will share with you about decoding market laws from liquidity sweeps to the game of the market makers. And the first part we will explore today is the price sweeps. This is one of the market's secret weapons. Price sweeps are the phenomenon where price moves rapidly through the significant highs or lows to trigger pending orders, then reverses. This is one of the laws I learned from thousands of hours of chart analysis. The market doesn't move in a straight line. It often cleans up liquidity before making its real move. In the gold USD chart, notice the sharp downward spike around September 30, which is the long pink candle from above 3880 down to below 3800. This is a typically downside sweep, breaking past previous lows and the stop loss of long positions. And the reason? Retail investors often take place their stop loss just below support, like a blue trend line, creating a liquidity pool. The market makers pushes the price down to clear out this stop loss, forcing them to sell at low price, while the market makers buy to accumulate. Afterward, the price bounces back up, as seen in a large green candle above 3890. From my experience, I will observe that the price sweeps often occur at Fibonacci levels in the chart. The buy 0.5 and the stop loss 0.5 levels might be a Fibonacci retracement. 0.5 is the 50% level. The price sweeps pass to test liquidity. And the next scenarios is often happened at low liquidity times, during Asian Open or US close, when volume is low and manipulations is easier. One more scenario we need to pay attention to is before the major news. Position themselves in advance, such as before the non-farm payrolls report. Economics explains this through semi-strong form efficiency theory. The market reflects information quickly, but large market makers like banks, hedge funds have an information and capital advantage to create artificial volatility and exploit the asymmetry. And now let's move to the next part of today's topic. Let's explore market maker game. Who wins? The house here refers to the market makers, large institutions like JP Morgan, Goldman Sachs, or major exchanges. The ones who provide liquidity and control the order flow. With nearly 8 years of experience, I can confirm the market is a zero-sum game where the house always wins and controlling by the rules. And how they play this game? First step, they're creating fake outs. In the chart, the red downtrend line could be a trap to lure short seller. The market makers push the price down to sweep the stop loss of longs, then buy and push it up, sweeping the stop loss of shorts above, which is we usually call it upside sweep. And they also refer liquidity hunting. They know where pending orders are concentrated through order flow data. For example, if many stop loss are below 3800, they push the price down to eat them, creating liquidity for their own position. And the last option they usually choose to manipulate the market is psychological manipulation. High volatility creates FOMO, or fear, causing retail investors to act impulsively. Behavioral economics call this herd mentality. The crowd follows, but the market maker goes against them. In gold USD, gold is a safe haven asset, so its volatility is often tied to the US index, DXY. But the market makers exploit this. When the Fed hints at an interest rate hike, they push gold down more than necessary to sweep liquidity, then let the price recover when the actual news isn't bad as anticipated. From a technical perspective, I use the Wyckoff method for analysis. The accumulation phase at the bottom, with the price sweeps to check out weak hands, followed by a markup or price increase. This chart is in the markup phase after accumulation, with the price sweep being the final test. To win this game, you must know the rule. Don't play stop loss too close to the support. Use volume profile to identify liquidity pool, and combine microeconomics like monitoring Fed minutes with the technical analysis. In 8 years, I have learned that 90% of investors lose because they don't understand the market makers. They trade based on emotion, while the market makers trade based on data. In conclusion, the volatility in the gold USD chart is not random. but part of a larger law. The market needs liquidity to move, and the market maker are the ones who clear it out through price sweeps. By understanding this, you will see the market as the chessboard where the knowledge is king. If you're trading gold, be wary of price sweeps if you side with the market makers. And that is the topic today. Thank you for your watching and see you in the next video.